welcome to Griffonomics.
Glad to be diving into this one.
Yeah, because right now, there are these massive technology companies pouring billions of dollars into building the future of artificial intelligence.
Oh, absolutely. Hundreds of billions.
Right. And they have the advanced microchips, they have the cutting-edge software, but they're sitting in this, agonizing 7-year waiting line for something so much more basic.
Literally just a plug.
Exactly, a plug. They literally cannot get the electricity they need to just turn these facilities on.
Yeah, it's wild.
So if you are looking to cut through the noise and grab the high-yield insights on what is arguably the most massive infrastructure shift of our generation, well, you are in the exact right place.
That is the mission today.
Today, we are looking at Quanta Services, ticker symbol PWR. And our primary mission for this deep dive is to unpack a really granular strategic report and investment roadmap.
Right, because we need to determine if Quanta is truly transitioning into this durable compounding business.
Exactly. Are they actually earning the title, the NVIDIA of the grid?
Which is a huge claim. And to figure that out, we are synthesizing a ton of source material for you today.
We've got a mountain of data.
We really do. We are pulling from their Q1 2026 earnings call, their incredibly detailed 2026 Investor Day presentations, the 10K and 10Q filings, and a whole stack of strategic market analyses.
Okay, let's unpack this, because to understand what Quanta is actually doing, you have to understand the core problem they're solving.
Right.
We're watching this kind of violent, slow-motion collision between big tech and big utility.
Precisely. It is fundamentally a timeline mismatch that is just paralyzing the entire industry right now.
How so?
Well, on one side, you have the technology hyperscalers. So the massive companies building these sprawling AI data centers,
Right.
they operate on what we call a rapid 5-second timeline. I mean, they want to buy the land, break ground, build a facility, and deploy the computing power instantly.
Because they have to win the AI arms race. Speed is everything.
Exactly. But on the other side, you have traditional electric utilities, and they operate on a much, much slower 5-year timeline, if not longer.
Yeah, their world is heavily regulated.
Completely. Before they can lay a single mile of high-voltage wire to power that new data center, they have to do multi-year environmental reviews.
The red tape is insane.
They fight through local town halls, they acquire right-of-way land permits, and engage in massive capital planning just to figure out who is paying for it.
And right now, because of this gridlock, hyperscalers are facing what? Severe 7-year interconnection queues?
Yeah, 7 years just to safely plug their data centers into the grid.
7 years. I mean, in the tech world, 7 years is an eternity.
It really is.
An AI model is obsolete in 7 months, let alone 7 years. If I'm a hyperscaler, I just can't wait until 2033 to turn my servers on. So how is Quanta actually bridging that gap physically?
Well, they are deploying what they call bridge power and behind-the-meter, or BTM, solutions.
Okay, what does that mean in plain English?
Essentially, Quanta is engineering a way for these tech companies to leapfrog that 7-year utility queue entirely.
Wow.
Yeah, they collaborate with partners like Bloom Energy, for example, to build off-grid, localized microgrids right there on the data center site.
So they generate their own power locally.
Exactly. This could mean installing massive arrays of solid oxide fuel cells, natural gas generators, and utility-scale battery storage.
Wait, I have to jump in here and play the skeptic for a second.
Oh, go for it.
Running an intermittent microgrid at an AI scale sounds incredibly complex and honestly super risky.
It is.
Because an AI data center cannot handle a split-second power drop, right? It crashes the trading models entirely. So managing this complex on-site generation with fuel cells and batteries, is this just a temporary Band-Aid?
I hear you.
Just feels like a desperate stopgap move by tech companies who literally have no other options.
What's fascinating here is the transitional strategy behind it, because, you are absolutely right to be skeptical. Tech companies do not want to run their own private electric utilities forever.
Right. They want to build software, not manage natural gas pipelines.
Exactly. The operational complexity of managing a microgrid at an AI-driven scale, balancing fuel inputs and battery degradation, is massive. But Quanta designs these behind-the-meter microgrids specifically as a transitional step.
Okay, so it's a bridge.
Yes. The hyperscaler gets online today, generating revenue, but Quanta is already working simultaneously on the long-term utility connection.
I see.
So once the main grid finally catches up, Years down the road, when the heavy transmission lines are finally permitted and built, the vast majority of these BTM microgrids don't just get torn down.
They don't. What happens to them?
They seamlessly synchronize and connect to the main utility grid. And at that point, the microgrid transitions into highly lucrative permanent backup power for the facility.
Oh, wow. Which they desperately need anyway to prevent those system crashes.
Exactly.
So they solve the immediate desperate pain point today while simultaneously building the long-term safety net for tomorrow.
That is the whole strategy.
But to actually build these bridge microgrids, let alone the long-term grid upgrades, Quanta had to solve the industry's biggest physical bottleneck.
The equipment.
Right, the equipment. You can't just order a 500,000-pound high-voltage power transformer on Amazon Prime.
No, you definitely cannot. And this is where Quanta's strategic moat moves from just a conceptual idea into hard physical reality.
Because the supply chain is completely broken.
Completely. Right now, the entire power industry is choking on 36-month lead times for power transformers.
3 years just for a transformer.
Yeah, and these aren't simple machines. They require specialized, grain-oriented electrical steel, bespoke engineering, and highly skilled labor to wind the copper coils.
And if you don't have a transformer?
If you don't have a transformer, you don't have a data center, and you don't have a grid upgrade, you literally just have an empty building.
So what did Quanta do about it?
Quanta made a massive, really aggressive move. They announced a $500 million to $700 million multi-year capital investment to double their own power transformer manufacturing capacity.
Hold on, investing $500 million into heavy manufacturing.
Yeah.
That seems incredibly risky for a company whose primary business is construction and engineering. I mean, why wouldn't they just sign better ironclad supply contracts with existing manufacturers instead of trying to become a manufacturer themselves?
Because an ironclad contract doesn't mean anything if the physical copper and steel simply do not exist in the market.
Good point.
The global supply chain for these components is completely tapped out. By verticalizing and bringing that critical component manufacturing in-house, Quanta bypasses that 36-month wait entirely.
So they are taking matters into their own hands.
Exactly. They are a top 5 global purchaser of high-voltage equipment. By controlling our own supply destiny, they guarantee what management calls schedule certainty for their clients.
Schedule certainty. Okay, so a hyperscaler knows that if they hire Quanta, the transformer will actually be there on day one.
Spot on. And their competitors, who are relying on third-party suppliers, simply cannot match that guarantee.
It's kind of like a chef buying the farm to ensure they never run out of ingredients during the dinner rush.
That's a perfect analogy.
So it's about removing the ultimate variable. If they are hoarding transformers and building factories, that obviously ties up a massive amount of cash, but it gives them a completely unique product.
Yes, and it goes beyond just manufacturing the transformer. They are drastically changing how the actual construction happens.
Oh, really? How so?
Well, Quanta is combining this vertical supply chain ownership with a massive expansion of off-site fabrication.
Off-site fabrication.
Yeah, they are nearly doubling their off-site manufacturing and logistics footprint to an astounding 6.7 million square feet.
Wow, 6.7 million.
Basically, they are creating AI factories for the grid.
So they are moving the really complex construction work away from the muddy, unpredictable job site in the field and moving it into a controlled indoor manufacturing environment.
Yes. And you pair that 6.7 million square feet of fabrication space with Quanta's unique labor model.
Which is what?
They self-perform 80 to 85% of all their work.
Oh, meaning they aren't just brokering subcontractors. These are actual Quanta employees.
Exactly. During their investor day, management made this really profound point. They said the human mind simply cannot keep up with how fast AI transmits data.
Obviously.
And you cannot replace physical craft labor in the field with technology. An algorithm cannot string a 765 kilovolt wire.
Right. You need human hands for that.
But you can make that physical labor incredibly efficient by prepping materials, assembling complex components, and pre-wiring systems in these massive off-site hubs. The highly paid craft workers in the field aren't just standing around waiting for parts to arrive.
Or fighting the weather to assemble intricate electronics.
Exactly. They just receive the modular components and execute the installation with incredible speed and precision.
Okay, so they're building these massive off-site AI factories and hoarding transformers. But doing that requires tying up a ton of capital.
It does.
So is that physical moat actually translating into pricing power, or are they just burning cash to win bids?
Let's look at the numbers. Because the Q1 2026 data we have in front of us is wild.
It really is.
I mean, a record $48.5 billion consolidated backlog. Q1 revenue alone hit $7.9 billion.
Massive number.
And they didn't just have a good quarter, they actually raised their earnings guidance for the entire year, targeting upwards of $14 a share in adjusted EPS.
Wall Street loves that kind of visibility.
Oh, they definitely do. But I imagine there's more to that backlog than just the headline number.
You're right. The sheer size of that $48.5 billion backlog isn't actually the most important part. It's the composition of that backlog.
What do you mean by that?
Historically, heavy construction companies relied on risky, one-off open market bidding. A utility puts out a massive project, 5 companies bid on it, you win some, you lose some.
And if you miscalculate a bid by even a few percentage points, you completely destroy your profit margins. Precisely. Quanta has deliberately and systematically abandoned that model. Today, roughly 75% of their work is directly negotiated.
Meaning they aren't waiting for a utility to publish a bid document. They are already sitting in the utility's boardroom, helping them design the multi-year capital spend.
Exactly. They are embedded in the planning process. And this dramatically shifts their risk profile. Less than 15% of their revenue today is tied to those large fixed-price mega projects over $300 million.
So they basically traded high-wire mega bids for programmatic, predictable, recurring partnerships.
Yes, and this embedded trust allows Quanta to deploy what they call a system of systems innovation approach.
System of systems. What does that actually look like on the ground?
Well, normally a tech company building a data center might hire one contractor to clear the land, another to build a solar array, a third to install the battery storage, and a fourth highly specialized firm to handle the high-voltage interconnection to the grid.
It's piecemeal.
Exactly. But Quanta provides a total turnkey solution. They bundle all of it together. Because they control the supply chain we just talked about and self-perform the labor, they drastically increase the revenue per megawatt they capture from a single client.
They become the single point of accountability.
You got it.
Let's pause there and talk about the NiSource partnership mentioned in the sources, because the numbers here look completely counterintuitive.
Yeah, that's a great example.
So Quantis is doing this exact system of systems turnkey execution for NiSource, which is a mid-cap utility in the Midwest.
Right.
NiSource had to support massive new data center load demand. We're talking 1 to 3 gigawatts of power. Now, a mid-cap utility does not have the balance sheet or the risk tolerance to execute a multi-billion-dollar generation project alone.
Definitely not.
So Quanta steps in, provides the turnkey execution, absorbs the construction risk, and gets the data center online.
Standard playbook for them now.
But the ultimate result highlighted in the report is that this project is projected to drive down local monthly utility bills by $7 to $8 for the ultimate ratepayer.
Yep, it drops the bill.
Why would an AI data center drawing massive amounts of power lower my grandma's electric bill?
Yeah.
That seems to completely defy the laws of supply and demand.
It does seem counterintuitive, right? But it all comes down to how utility economics and fixed costs work.
Okay, walk me through it.
Think about the massive fixed costs required to maintain a power grid. You know, the poles, the wires, the substations, the baseline generation plants. Historically, those huge capital costs are divided up and paid for by the local residential and commercial ratepayers based on their usage.
Right, everyone pays a share.
Now, drop a massive AI data center into that local grid. That data center uses an astronomical amount of electricity, 24 hours a day, 7 days a week. Because the data center is consuming such a massive volume of power, it ends up absorbing the lion's share of those fixed infrastructure costs. You are socializing the cost of the grid upgrades over a massively expanded pool of consumed energy.
Oh, I see.
So the cost per kilowatt hour actually drops for everyone else.
Because the denominator, the total energy consumed on the system, explodes, the residential burden shrinks, even though the total infrastructure cost went up.
Exactly.
That is fascinating.
Yep.
The hyperscaler gets speed, the utility gets de-risk infrastructure growth without blowing up their balance sheet, and the everyday ratepayer gets a lower bill.
It's a fantastic mechanism, and it explains why Quanta's backlog is so resilient.
But look, a $48.5 billion backlog is only impressive if you can actually execute it when things inevitably go wrong. And in the heavy industrial world, things always go wrong.
Always. That is the reality of the physical world. A permit gets denied at the last minute. A local municipality stalls a right-of-way negotiation. A freak weather event halts site prep.
So how do they protect themselves from just bleeding cash when a project halts?
This brings us to Quanta's ultimate safety net, which is their labor fungibility.
Labor fungibility.
Yes. Quanta employs the largest craft-skilled workforce in North America, over 70,000 workers. But crucially, they aren't siloed into separate, rigid divisions.
Interesting.
Quanta continuously cross-trains this workforce across a converging $2.4 trillion addressable market.
Here's where it gets really interesting, because the sources describe this labor fungibility operating a lot like a computer's operating system reallocating RAM.
That's a really good way to think about it.
Yeah, if you open a heavy video editing application, your computer seamlessly pulls memory from your web browser to support the task that needs it most. Quanta does the exact same thing, but with highly specialized physical labor.
Exactly.
But humans aren't RAM. How does a crew outstringing high-voltage wire suddenly go build a solar farm?
It requires immense foresight and continuous investment in training, which is why that 80 to 85% self-perform model is so critical. Because they are all Quanta employees, the company can standardize safety protocols and operational training across different energy sectors.
Okay.
So if a massive 765 kilovolt transmission line or a utility-scale solar project gets bogged down in a sudden environmental permitting dispute.
Quanta doesn't just leave those highly paid crews sitting idle in a field.
Exactly. And that is usually the death knell for margin in traditional construction. Idle crews destroy profitability.
Yeah, paying guys to stand around is bad business.
Right. Instead, Quanta seamlessly pivots that exact same crew without incurring massive retraining delays or onboarding costs to an active combined cycle gas plant project or a booming AI data center build happening in the next county over.
They basically force multiply their workforce.
Exactly. This guarantees continuous production and incredibly high utilization rates regardless of localized market shocks or permitting delays.
And they are capturing even more of the profit along the way because of their recent acquisitions, right? They recently acquired Dynamics Systems and W.T. Byler.
Yes, and this plays directly into the labor fungibility strategy. Dynamic Systems brings turnkey mechanical, plumbing, and process piping infrastructure in-house.
Got it.
W.T. Byler brings civil site preparation, heavy earthwork, and concrete pouring.
Okay, so how did it work before?
Well, think about how a project used to work. If Quanta was building a massive substation, they would have to hire third-party subcontractors to clear the dirt, pour the concrete, or handle the complex cooling plumbing. They had to pay a profit markup to those external companies.
Wait, so now they are essentially just hiring themselves.
Exactly. Quanta keeps that work entirely in-house. Their electric power segment essentially hires their own underground and infrastructure segment to do the civil prep.
That's brilliant.
They capture all of those intercompany margins that used to bleed out to third parties. By locking that value inside the enterprise, they prevent margin erosion, even amid a deeply inflationary labor market where wage costs are rising everywhere else.
Okay, so let me summarize. They own the physical supply chain, they have a massive cross-trained labor force that they can redeploy like RAM, and they're capturing all the intercompany margins from the ground up.
That's the playbook.
But no deep dive is complete without stress testing the bear case. Let's play devil's advocate for a minute here.
Let's do it.
The market is currently valuing Quanta at a premium 32 times forward PE multiple.
Which is high.
That is a massive premium for an industrial stock. Investors are calling them a utility SaaS hybrid.
Right.
They're comparing their revenue visibility to a software-as-a-service tech company because 45% of their total backlog is made up of recurring master service agreements, or MSAs.
Yeah, that's the narrative.
But come on. Can we really call a company that pours concrete and strings high-voltage wire a SaaS business? Are Wall Street analysts just completely ignoring the reality of the physical world?
If we connect this to the bigger picture, the bears have a very valid point, and that SaaS comparison is highly controversial.
I mean, it sounds ridiculous on its face.
It does. Calling a heavy industrial contractor a SaaS company willfully ignores catastrophic physical hazards. Microsoft doesn't face multi-billion-dollar wildfire liability risks if a line they built sparks a devastating fire in California.
Exactly.
Software companies don't have to navigate Byzantine environmental permitting regulations across 3 different state lines just to push a code update.
Right.
Furthermore, while master service agreements provide great baseline visibility, the legal reality is that under most MSAs, customers generally have no strict obligation to assign a specific minimum amount of work.
Right. So if the macroeconomy suddenly cools off, or if these tech hyperscalers decide they've overbuilt and abruptly pause their capital expenditures, those recurring MSA revenues can dry up very quickly.
Very quickly.
And Quanta would be left holding the bag on 6.7 million square feet of manufacturing space and 70,000 employees.
That is the core risk right there. And you look at the strategy to build those massive 765 kilovolt ultra-high voltage transmission lines. Management themselves explicitly stated that right-of-way acquisition and environmental permitting are severe, ongoing bottlenecks.
You can't just pivot thousands of workers forever if the entire macroeconomic environment slows down.
Yeah.
They are still a cyclical industrial business operating in the dirt and the weather.
It's exactly.
So how does management defend that premium valuation against those very real physical risks?
The bull defense is really rooted in the sheer scale of the multi-decade supercycle we are entering. Quanta's management is not blind to the risks, but their compounder targets reflect a high degree of confidence in the unavoidable physical math of grid expansion.
The physical math.
Yeah. Take those 765 kilovolt transmission lines, for example. Management points out that building just one of those massive interstate lines drives a 10-to-1 ratio of smaller underlying grid projects. Oh, like a cascade effect.
Exactly. You finally get the big line permitted and built, and suddenly you need 10 smaller local distribution lines, step-down substations, and local grid reinforcements just to handle the new capacity safely.
It just feeds an entire ecosystem of follow-on work.
It does. And because of that massive cascade effect, combined with their shift to direct negotiation and their vertical supply chain, management remains highly confident in telling the market they can achieve a 15 to 20% adjusted EPS compound annual growth rate through 2030.
Wow, 15 to 20%.
Yeah, they are signaling that their earnings power is highly visible, deeply entrenched, and capable of double-digit compounding despite the muddy, unpredictable realities of this space.
So what does this all mean for the listener trying to make sense of this market?
It's a paradigm shift.
We set out today to understand how Quanta is monetizing the physical bottlenecks of the digital AI boom. And what is so striking is that they aren't just passively riding the wave of AI demand. They are actively engineering the physical bridge that allows the wave to happen at all.
Without Quanta's transformers, their microgrids, and their fungible labor force, the brightest tech minds in the world are just waiting in a 7-year line for a utility hookup.
It really raises a vital perspective for anyone looking at the AI revolution. We spend so much time analyzing semiconductor chips, the efficiency of software algorithms, and the architecture of the cloud.
Right, the digital stuff.
But the absolute ceiling of that entire digital ecosystem is firmly rooted in the physical world.
It leaves you wondering if physical infrastructure and the sheer availability of electricity are becoming the true, undeniable bottlenecks to digital progress. Will we start seeing tech giants like Microsoft or Google attempt to buy heavy construction firms outright just to secure their own grid expansion?
That would be something.
It's a wild thought for the future. But as we've seen today, controlling the physical world is the only way to dominate the digital one. Rift defined, portfolio protected,